In the world of cost accounting, standard costing is like the backbone of financial management. It's that structured framework that helps organizations estimate, track, and analyze the costs associated with their products and services. But here's the thing. As companies strive for greater efficiency and smarter cost management, there's a common oversight that keeps popping up. It's like that one friend who always forgets to bring snacks to a road trip. You know they're essential, but somehow they slip through the cracks. I'm talking about the failure to adequately incorporate depreciation and capital expenditures into standard costing. Now, you might be wondering, what's the big deal? Well, let's break it down. When we think about standard costing, we usually focus on the variable and fixed operational costs. You know, the usual suspects like materials, labor, and overhead. But what about those periodic expenses related to equipment replacement, machinery depreciation, and facility upgrades? These factors can significantly influence a company's overall cost structure, and when they're overlooked, it can lead to some serious consequences. Imagine you're running a business and you've got your products priced just right. You think you've got it all figured out, only to find out later that you've been underestimating your cost because you didn't factor in depreciation. Suddenly, those artificially low standard costs could lead to mispricing, poor profitability analysis, and ultimately, bad decision-making. It's like trying to bake a cake without measuring the ingredients. It might look good on the outside, but when you cut into it, you'll realize it's a disaster. Let's talk about depreciation for a moment. It's that systematic allocation of the cost of a tangible asset over its useful life. Think about all the equipment and infrastructure your business relies on. Manufacturing machines, IT systems, vehicles, even buildings. Failing to accurately account for depreciation can result in distorted product costs. You might think you're making a profit, but in reality, you're setting yourself up for financial trouble down the line. And then there's capital expenditures. These are the funds used to acquire, upgrade, or maintain physical assets, and they play a crucial role in shaping your cost structure. If you're not incorporating the impact of capital expenditures into your standard costing, you're missing out on a big piece of the puzzle. It's all about linking costs to strategic investments. By aligning your standard costs with your capital investment decisions, you can better understand the financial implications of your initiatives. This isn't just about crunching numbers, it's about making informed decisions that drive your business forward. So, how do we fix this? First off, it's essential to establish depreciation policies and schedules that align with your asset management practices. You need to determine useful lives for your assets, select appropriate depreciation methods, and implement periodic reviews to keep everything up to date. It's like giving your financial strategy a regular checkup to ensure it's healthy and functioning well. Next, let's integrate those capital expenditures into your standard costs. This means identifying upcoming capital projects, estimating their costs accurately, and figuring out how to allocate those costs within your standard costing framework. It's about being proactive rather than reactive, ensuring that you're prepared for the financial impact of those investments. And here's the kicker. You have to align it all with your strategic objectives. Your capital investment decisions should be closely linked to your overall goals. If you're investing in new technology, for example, you need to incorporate the anticipated cost impacts into your standard costing model. This way, you're not just throwing money at problems, you're making strategic decisions that support your long-term vision. Now, let's talk about technology. In today's world, leveraging advanced enterprise technologies is key to enabling integrated cost management. Think about ERP systems that provide a centralized hub for capturing and consolidating your asset management data, or specialized asset management software that tracks the life cycle of your capital assets and automatically calculates depreciation. These tools can transform your approach to standard costing, giving you the insights you need to make informed decisions. The benefits of integrating depreciation and capital expenditures into your standard costing are immense. You'll achieve accurate product and service costing, informed capital investment decisions, enhanced cost visibility, and improved resource allocation. It's like turning on the lights in a dark room. Suddenly, you can see everything clearly, and you can make better choices. As the business landscape continues to evolve and grow more complex, the ability to effectively integrate these components into your standard costing practices will be a critical success factor. It's not just about keeping up, it's about positioning yourself for long-term success in a competitive market. By embracing a holistic, data-driven approach to cost management, you're setting your company up for sustainable improvements in financial performance, operational efficiency, and resilience. So, if you're in the world of cost accounting or finance, take a moment to reflect on your current practices. Are you incorporating depreciation and capital expenditures into your standard costing? If not, it might be time to rethink your strategy. Remember, in the fast-paced world of business, those small oversights can lead to significant consequences. Don't let your financial health be one of them. Embrace the integration of these critical components and watch your organization thrive.